Alright, so we've seen some unrealized gains tax here being pushed in Europe. I saw this video being sent in the Discord. Let's react to it real quick, because some investors in Europe are not okay right now.
Let's say your investment portfolio goes up €10,000 this year. You don't sell or cash out, but the Dutch government sends you a tax bill for almost €4,000. That's the law the Netherlands just passed. Starting January 2028, Dutch residents will pay 36% tax on paper profits from stocks, bonds and crypto, even if they never sell a single asset. In this video, we'll cover how this unrealized gains tax works and the dire warning for you even if you're not a tax resident in the Netherlands.
And I will also cover some of the similar but lighter proposals that we've seen in Europe and the effects of them, because we've seen greater effects from far less than what the Netherlands is doing.
Why is this happening? Well, simply put, the Netherlands is doing this because their Supreme Court forced the government's hand. The old Dutch system taxed investment income based on assumed returns. The government would calculate a fictional rate of return and tax you on that, regardless of what you actually earned. In December 2021, the Supreme Court ruled that this system violated property rights under the European Convention on Human Rights. Taxing people on income they never received was unconstitutional. Since then, the government has been scrambling to find a replacement for the lost revenue. Every year without a fix cost the Treasury an estimated €2.3 billion. So lawmakers faced a choice: tax unrealized gains now or wait years to build a system that only taxes gains when you actually sell them. They chose the quick fix. How the new system works. The Netherlands divides personal income into 3 boxes. Box 1 covers employment income. Box 2 covers income from owning at least 5% of a company. And Box 3 is the one that just got overhauled, covering savings and investments. Under the new system, Box 3 taxes actual returns at a flat 36% rate, but actual returns now includes unrealized gains. If you hold €110,000 in stocks on January 1st and they're worth €110,000 on December 31st, you owe tax on that €10,000 increase, even if you never sold a single share and can't use those funds. There's a small exemption. The first €1,800 in annual returns is tax-free. Anything above that gets taxed at the full 36%. If you have a bad year, you can carry that loss forward indefinitely and use it to offset gains in future years. But only losses exceeding €500 qualify. What's included and what's...
Alright, so that's an important point, especially for crypto traders in this case. I've seen it in Sweden, where we have a lesser deduction for losses in crypto and a higher tax in gains, and some people who have been doing a lot of buying and selling, basically doing break even, were taxed hundreds of thousands of Swedish krona, and they have no idea what they're doing. That's why it's so important to know the tax laws, and one of the reasons why I meet with tax professionals from time to time.
Exempt. So the question on every investor's mind has to be what is included in Box 3 and what isn't. Not every asset gets the same treatment. Stocks, bonds, mutual funds, ETFs and crypto are all subject to the annual mark-to-market approach. The tax authority assesses your portfolio every year and taxes the change in value. But real estate and shares in qualifying startups follow different rules. For those assets, the government uses a traditional capital gains approach. You only pay tax on the appreciation when you sell or dispose of the asset. The government explicitly acknowledged that forcing people to pay tax on paper gains in illiquid assets creates serious problems. If your rental property appreciates but you don't sell it, you don't have...
Yep, like it did in Norway. Let's just show really quickly here regarding Norway and the wealth tax here. So 1% of assets exceeding roughly 2 million Norwegian. So divide this by 10 and you get a fair amount in euros and dollars, roughly somewhere there. And you can see how this impacts business owners. Perhaps that's the reason why the Netherlands government made an exception for this. We saw a huge exodus from Norway in this case. So if you have a fortune on paper in terms of owning a private company that you built from the ground up, and you have paper gains, and all of a sudden, you know, you have to pay 1 million in tax and it's more than your income, well, you need to take out dividend perhaps from that company. You can't reinvest into the business. Those dividends, just to cover tax, also taxed at 37.84%. And like Mr. Kolstad pointed out here, that this gives you a choice either to sell your business or move abroad, move away from Norway. So we've seen this having catastrophic results. So good on Netherlands for avoiding this, although I think that this wealth tax, this unrealized capital gains tax, will have serious consequences in Netherlands. We will see, and we will point our finger and laugh.
Cash to pay a tax bill. Crypto and stocks didn't get the same consideration. This exemption for real estate is worth paying attention to if you're thinking about restructuring. And if you're considering relocating to a country with a golden visa program, real estate often serves double duty. It qualifies you for residency, and it's a more tax-efficient asset class in many jurisdictions. By the way, IMI has a database of RCBI qualifying properties at IMI Real Estate, if that's a path you're exploring. The liquidity problem. Okay, so the sharpest criticism is about the bill's own explanatory memorandum that acknowledges what it calls liquidity risk. Think about what this means in practice. You buy Bitcoin, it doubles over 5 years. You never sell because you believe in the long-term thesis. Yet every single year you owe 36% on that year's gain, even though you have no cash from the investment. Where does that money come from? You either sell some of your position to pay the tax, which might trigger even more tax and defeats the purpose of holding, or you pay out of pocket from other income. For high net worth individuals with diversified income streams, this is annoying but could be manageable. For someone who's crypto heavy or concentrated in a single asset class, it could force liquidation at the worst possible time. Cointelegraph reported that many Dutch crypto holders are already considering leaving the country.
Yeah, what's the worst possible time? The worst possible time is you have a huge gain, and then exactly after the cutoff date, you see a big sell-off in that specific asset where you're heavily concentrated. And all of a sudden you owe tax massively. Let's say that you had SaaS companies going into this year, and we've seen them crater by 80%, some of them, and you owe taxes on gains that no longer exist. And, you know, even if you sell all those assets that are remaining, you can't cover the tax bill. That would be the worst possible time. So for riskier assets like crypto, like growth stocks, this is very, very dangerous for investors. And it no longer makes sense to take the highest level of risk. It makes more sense to take lower levels of risk. But, you know, higher risk, higher return, it will make it just more difficult for normal people to build real wealth.
According to De Nederlandse Bank, indirect crypto investments held by Dutch entities reached 1.2 billion euros by October 2025, up from 81 million euros at the end of 2020. That's a lot of paper gains that are about to become taxable. How this compares to Europe. So in the grander scheme of things, how do other European jurisdictions compare to the Dutch approach? Well, almost no other European country does this. Most European nations that tax capital gains do so only upon realization, when you actually sell. Norway taxes capital gains at realization. Germany applies a flat 25%.
And this is why it's important to always do your own due diligence, do your own research. We see some figures being mentioned here. Norway only taxing at realization. We know that this is not the case. We know that they have a wealth tax here, so they tax unrealized gains if you have more than roughly 200,000 euros. And we see, for example, in Ireland, they also tax unrealized gains, but only on ETFs every 8th year. In some countries, they have exit tax, and there's just different tax rules. So always consult with a professional and never just, trust a video that you see on YouTube.
Withholding tax on investment income, also at the point of sale. France, Austria, Denmark, they all wait until you sell. For context on how the Dutch top rate compares with the rest of Europe, at 40.
So Denmark is one of those examples who have a heavy exit tax. If you leave with unrealized gains, they will tax you. They will take a big bite out of that apple. And for those of you who are watching this from the US, well, you guys have California, so you know what I'm talking about. It's not only the Euro poors who are hurting, it's also some residents in American states.
59.50% on employment income, it's among the highest in Europe. Denmark leads at 55%, followed by France at 55.4% and Austria at 55%. At the lower end, Bulgaria and Romania levy a flat 10%, and Hungary's top rate is 15%. Eastern Europe, as you can see, has far friendlier normal tax systems than Western Europe does. The Dutch approach of assessing portfolios annually and taxing the change in value is an outlier. Several parties in the governing coalition have acknowledged this and have said publicly that taxing unrealized gains isn't their preferred approach. But they backed the legislation because they needed a legally viable framework, and this was, again, the quick fix. The stated goal is to eventually transition toward a realized capital gains model, but eventually could be years away. If you're considering tax residency in the Netherlands or already are one, you have roughly 2 years to figure out your strategy before this takes effect in 2028. Option 1 is to restructure your portfolio. Recall that real estate and qualifying startup shares are exempt from the annual mark-to-market approach. Option 2 is to use the loss carry-forward provision strategically. If you expect volatility, timing your gains and losses across years could help manage your tax burden. And of course, option 3, the most effective option, is to relocate. If you establish tax residency in a country that doesn't tax unrealized gains, the Dutch rules no longer apply to you. Countries like Italy, Greece, Malta and Cyprus offer favorable tax treatments for new residents, including flat tax options, territorial taxation, and in some cases, complete exemption on foreign investment income, which you can learn more about in the video linked at the end of this video. If you're serious about exploring relocation in Europe.
So that's a very good video highlighting one of those issues who many investors might not be aware of. So a great share in the Discord, very much appreciated, making sure to react to it. And, always do some tax planning here. The European systems are very, very different. In Sweden, where I'm from, we abolished the wealth tax here in 2007. It's been an absolute blessing. A very high number of millionaires in Sweden right now, very, very wealthy in terms of the levels of capital that people have. But one of the things to be aware of for expats from Sweden, sharing some of the due diligence I've done here, for you guys freely, is that there's a 10-year rule in some cases. So if you have a lot of unrealized gains and you move away from Sweden and you sell these in Dubai at 0% tax rate, the year after, well, this could be clawed back in court. And in some cases, speak with your tax professional. It could be prudent to just wait 10 years and then sell those investments when you're outside of that country for the legal jurisdiction to have no claim to those capital gains. But what do I know? I'm just an expat from Sweden with no schemes of my own. That's been it for this video. And as always, hope you guys make a ton of money, whatever investments you decide to make. Take care now. Bye bye.